Look, if you're an investor or even just someone who casually skims the financial news, you've almost certainly heard a really comforting piece of advice. It usually goes something like this. Just buy a good stock, hold on to it for the long haul, and your wealth is just going to naturally grow over time. I mean, it sounds perfectly logical, right? It's the ultimate set it and forget it dream. But in this explainer, we're actually going to look at what a full century of market data proves. And, well, spoiler alert, that comforting piece of advice, it might just be one of the biggest statistical illusions in financial history. We're diving straight into the numbers today, and what we uncover is absolutely going to change how you view your portfolio.
All right, let's jump right into section 1, the truth about stocks.
To really get to the bottom of this, we need to look at Professor Hendrik Bessembinder's monumental analysis. He looked at nearly 30,000 stocks listed in the US over almost a century. And diving into this massive data set forces us to ask a pretty fundamental question. If a rising tide lifts all boats, why is picking individual stocks still considered so incredibly risky? We see indices like the S&P 500 constantly breaking new records, so we just naturally assume that most stocks go up over time. But if buy and hold is an automatic win, why do so many active investors completely fail to beat the market?
51.8%. Just let that number sink in for a second. According to the data from the last century, over half of all stocks yield a negative return over their entire lifetime. From the moment they IPO to the moment they get delisted, or up to the present day, more than 1 in 2 stocks will literally lose you money. So that baseline assumption that most businesses grow over time, it's mathematically false. If you just threw a dart at a massive list of all historical stocks, you are statistically more likely to hit a lifetime loser than a winner.
The reality of playing the individual stock market is honestly pretty brutal. Nearly 60% of stocks perform even worse than a 1-month US Treasury bill. Now keep in mind, a Treasury bill is basically a risk-free asset. You take practically zero risk by holding it. And yet nearly 60% of all publicly traded companies, we're talking businesses with CEOs, sprawling corporate offices, massive marketing budgets, and tons of risk, fail to beat the safest, most boring investment on the planet.
And here is the real kicker. Negative 6.9% is the median lifetime return of a stock in this century-long study. The median is the dead center of all the data, right? So it means if you lined up every single stock from the absolute best to the absolute worst, the one exactly in the middle lost 6.9% over its lifespan. You're literally fighting against a baseline where the average historical experience of a single stock is just failure.
Moving on to section 2, a tiny group carries the market. So if the vast majority are losers, why do indices keep generating such massive historical wealth for people? Well, the answer lies in a vital concept called positive skewness. Now, I know that sounds like dry academic jargon, but it's actually the absolute secret engine of the stock market. Positive skewness is a statistical phenomenon where a tremendously tiny group of extreme winners create such unbelievably massive gains that they just pull the entire overall market average up with them. These ultra winners completely mask the terrible performance of everything else. The stock market isn't a democracy where everyone pulls their weight. It's honestly a profound oligarchy of returns. And the sheer scale of this positive skewness is staggering. Remember, out of nearly 30,000 companies analyzed over a century, just 46 businesses, that is a microscopic 0.16% slice, created 50% of the entire US market's wealth. We are talking about $91 trillion in wealth creation, and half of it came from just 46 companies. That massive 99.84% block of remaining businesses, they were essentially just along for the ride, or, in many cases, actively dragging the overall market down.
So who exactly are these heavy lifters carrying the entire stock market on their backs? Well, they're the legendary titans of industry. We're talking about your Apples, Microsofts, Amazons, Nvidias, and Alphabets, but also long-standing giants like ExxonMobil, Johnson & Johnson, and Walmart. These singular, incredibly exceptional businesses are the ones dragging the entire index into the green. Without these specific outliers, the historical return of the broader stock market would be, frankly, remarkably unimpressive.
Which brings us to section 3, not just tech.
Now, you might be looking at Nvidia or Apple and naturally assume the secret is just investing in whatever the most cutting-edge tech is. It's so easy to think it's all about tech and AI right now. But historically, a very different picture emerges. Yes, big tech absolutely dominates today, but the tech sector also has an incredibly high mortality rate. I mean, just think about the thousands of companies totally wiped out during the dot-com bubble back in 2000. When we actually look at the sectors that sustainably generated wealth over decades, we see energy, utilities, telecom, consumer staples, and healthcare. People often call these the boring sectors, but these unglamorous industries possess really steady cash flows, deep-rooted competitive advantages, and the sheer resilience to just compound profits decade after decade.
Ultimately, chasing a trendy sector label is kind of a trap. The modern lines between sectors are completely blurred anyway. We all think of Amazon as a tech giant, right? But technically, it's classified as retail. We think of Tesla as a pioneering AI and tech firm, but officially, it's classified as automotive. The crucial takeaway here isn't the flashy label on the industry, it's the underlying capability of the business to generate sustainable, long-term value. That is what actually puts a company into that elite fraction of a percent.
Let's zoom out a bit for section 4, a global rule. So you might be wondering, is this extreme winner-takes-all dynamic just a quirk of American capitalism, or is it a fundamental law of how markets operate everywhere? To answer that, Professor Bessembinder actually conducted a massive follow-up study analyzing over 64,000 stocks globally. He looked at major markets like the UK, Germany, France, Japan, and China, spanning from 1990 all the way to 2020. And what he found proved that this phenomenon is absolutely universal. Comparing the US and global realities is honestly eye-opening. Globally, 57.4% of stocks still underperform risk-free assets. In fact, a staggering 98% of global businesses only generate returns that are equal to or even lower than government bonds. Just like we saw in the US, almost all the wealth created in the global markets over those 3 decades came from just the top 2.4% of outstanding companies. So extreme positive skewness isn't just an American anomaly. It's pretty much the fundamental gravitational law of global capital markets.
All right, final part here. Section 5, Standard Investment Strategy.
So knowing all this, knowing that most stocks are losers and a microscopic percentage generate almost all the wealth, how on earth do we protect our portfolios? Well, it really comes down to understanding the true risk of stock picking versus index and ETF investing. When you buy and hold a random individual stock, the statistical odds are literally stacked against you. You run a very high risk of choosing a lifelong loser that won't even beat a standard treasury bill. But when you invest in a broad index fund or an ETF, you completely change the math in your favor. You aren't trying to guess the winner anymore. You're automatically ensuring that when those incredibly rare market winners do emerge and scale up, you already own a piece of them. ETFs act as this brilliant automatic filter. They hold on to the ultra winners while naturally phasing out the companies that are shrinking.
Which brings us to one of my favorite legendary investing phrases: stop searching for the needle, just buy the haystack. If the data conclusively proves that all the wealth is concentrated at 46 out of 30,000 companies, spending your life trying to perfectly predict which startup today is going to be the Apple or Nvidia of tomorrow is, well, it's a bit of a fool's errand. Buying the haystack, the broad index, guarantees that you capture those wealth-generating needles without exposing yourself to the devastating risk of picking the wrong individual stock.
And that leads us perfectly to this final thought. The most effective way to invest isn't finding one right stock in 30,000, it's owning the market and letting time choose the greatest businesses. This entire explainer really forces us to confront our own egos as investors, doesn't it? The market doesn't reward those who confidently pick the average stock because the data shows the average stock fails. It rewards those who have the humility to just buy the whole market and the patience to let the truly exceptional companies do all the heavy lifting. So as you look at your own portfolio today, you really have to ask yourself, are you stubbornly hunting for needles in the dark, or are you ready to finally just own the haystack?